Hello, everybody. My name's Andy. My channel's Finding Value. And if you guys want to subscribe to the channel, definitely subscribe. We're looking for undervalued investment opportunities, financial education. We're looking at markets and data, trying to determine what the data is telling us. That's why I'm here, trying to show you guys what to look at, what to look for. And that's what this is about. I'm going to look at the copper to gold ratio. The copper to gold ratio and the 10-year yield are basically tied together. What the copper to gold ratio tells us. And I know some of you guys, what does copper have to do with gold? What does uranium have to do with gold? It's like, it has everything to do. Gold was once our money. It was backing the dollar. It's constitutional money. It's written in our Constitution that we should have gold and silver as money. Although it's not money right now, it is still the gold standard. It is the standard that you measure your assets against. And why would you measure your assets against it? Because it's basically an indication of inflation. It accounts for inflation in the system. Gold goes higher, and it's an inflation indexed way to value assets, period. If you understand that, if you get your ratios right, if you understand how to value assets, you win as an investor. You don't win by pricing it in dollars. You don't win. And there's two components to commodities moving. One component is an inflation portion, because we always get commodity booms under a weak dollar. We don't get commodity booms under a strong dollar. And two, we have the supply and demand component. We need those two things. And I think the driver of most of this is the market conditions and a weaker dollar. It's not the supply and demand. That does drive some commodities when the supply demand gets way out of whack, like a palladium or a rhodium. But the majority of the sectors, like oil, and I think even uranium, because it's in the energy sector, money flows seek these areas under a weak dollar. So to say that everything is based off the supply and demand is a huge false statement. It's based off of the rotation of money between sectors. And what rotates the money, you guys should know this, interest rates do. But what moves interest rates? Inflation, a weaker dollar. So a weak dollar, people look and view assets differently. The market conditions change. And what I'm looking at in this presentation is what tells us that the market conditions are changing. Copper to gold ratio does. Copper outperforming gold signals that we have a stronger demand for commodities and a weaker dollar. And we're going to see higher interest rates. Why do I say that? All these deflation guys, they look at all this data, but I think they're looking at the wrong data. The copper to gold ratio would tell you if copper's outperforming gold, that means something. And that's what that ratio is telling us. And I'm going to show you some chart patterns to show you that copper, I think, is going to outperform gold during this next bull market. And interest rates follow the copper to gold ratio. They are very closely linked. So I'm going to jump in here. I'm going to show you those correlations. But I went straight into charting here. So this is the copper to gold ratio on a very long-term perspective. The last bull market, the copper to gold ratio, we basically started in 99, 98. It came up, pulled back, and then it ran. When this thing outperforms, this was a expansionary phase of real estate from 04 to 06. When this thing runs, we get a nice big move in commodities. And you can see that we had a pattern here that it broke. You could draw it across. It's right here. It broke to the upside, ran a little bit, and then our driver of inflation, which is real estate in an expansionary phase of real estate, that went away, and then there was nothing supporting the copper price. So what happened was copper and gold rotated. Copper underperformed gold, and we came on down in a recovery phase of real estate. And in a recovery phase from 2000, I would say 8 onward all the way till 2020, we don't have that inflationary pressure. We don't have high interest rates. And interest rates, they usually stay low along with inflation. But something changed here recently. we've got a downtrend line. I drew 2 of them in here, grabbing a bunch of tops. Copper broke to the upside of the first downtrend, and it broke the second one. And it's kind of paused at the top here, relaxing at the top of the second pattern. This is going to move to the upside. And the reason it's going to move to the upside is that we are in an inflationary environment at the moment. This chart is telling us that. And I see demand for copper and the price of copper going up quite dramatically over the next 5, 7, 8, 9, 10 years. Dramatically. So we might see this thing kind of pull up. We're early in this game here. We're going to pull up, but I think we're going to go all the way to 0.00035. So we're going to see an outperformance of copper over gold. What does it mean? So I'm going to focus in on this corner here just to show you. That's what the corner looks like. We did break to the upside of it. We back tested, and we're kind of still playing around with this line over here. We've got nice, good support. More than likely, this is going to continue higher. Let's look at the 10-year Treasury yield. Why does this matter? This sparks the rotation of money. This money rotated into gold and precious metals all through this increasing of interest rates here. Real estate went far higher. This was the demographic of the baby boomers that drove this thing higher. The demographic of the millennials, which is a larger population demographic than Generation X, is going to drive interest rates higher. And interest rates going higher, which inflation drives interest rates higher, going higher drives the rotation of money from stocks to commodities and precious metals. Regular stocks, that is. Technology stocks and whatnot. So here's it moving on higher. And this was a huge bull market for commodities and precious metals. And the oil price does not push all the prices higher. It's a weak dollar that does. A weak dollar. And we're right there. We're trying to break this trend line very soon here. It did bounce down a little bit, so we may create a little cup, but I think this is going to break this downtrend unless the Federal Reserve is in there buying it all up. It's possible. It's possible. Now, here's the copper to gold ratio and the treasuries, how they're linked. The turning points where this came up and turned back down. So copper to gold ratio was leading the treasuries here. It was leading the treasuries here. It was leading the treasuries there by a couple days. It's leading the treasuries here. So the copper to gold ratio, here's a turn down. You could see it was leading the 10-year. And it was leading the 10-year right here. See this big move higher and how the treasuries were delayed? Right here at kind of the end of 2020, copper to gold ratio went up and the 10-year didn't move. If you look at late 2020, which was over here, the 10-year did move higher, just delayed after the copper to gold ratio. The copper to gold ratio right now, if you were to look, is going down a little bit to back test just recently. So we're going to see the 10-year come back down as well. And will this pull back much? We've got a bearish engulfing here. It could pull back, break this trend line, but I think overall the trend's going to be higher for 10-year yields. And the reason I talk a lot about 10-year yields is because it affects the rotation of money in the entire market. This is something that you have to understand. Inflation, interest rates, and then the rotation of money after it. In an expansionary phase of real estate, interest rates move higher because the demand for money goes up, the demand for loans. Now, we are under, some of this stuff may go a little bit slower because we can't build as many homes if we have shortages of supply chain stuff. If we do have, there is a shortage of lumber, and that's why the prices are higher. Now, some of this stuff, I think the government or Federal Reserve, they're just going to lie. They're going to tell you that there's a shortage in supply chain shortage of everything, and that's why prices are going higher. I think they're just lying to you. Prices are going higher because they're printing money. They're printing lots of money and handing it to everybody. We're going to see the velocity of money kick up this summer. We're going to see oil prices kick up as people start to travel more. And there's going to be impacts to the economy from all of this money coming into the system. It's going to be inflationary. I think we're going to see a kick up of interest rates potentially because of inflation. You should see the copper to gold ratio go higher. That'll be our leading indicator if the 10-year is going to move higher. Now, if the 10-year blows out to the downside, breaking this pattern here, it could signal that there's problems, especially if the copper to gold ratio follows. If the copper to gold ratio goes down and the 10-year goes down, it means people are running into bonds and that they're scared of something. They're scared of something, whatever that may be. So we'll have to monitor it. If we see it go down quite a bit over time, that might be a time where you want to put some of your stocks into a free ride and conjure up a little bit more cash. Now, I'm not saying that there's going to be a crash. Right now, we're right at the trend line, and these things have to come back down. We have to see real estate come back down. Now, if none of that comes back, it's all game on. You should do nothing. So if you guys like this presentation, give me a thumbs up. Leave comments and questions below. And thank you for listening. This is Finding Value.